Welcome to this month's Fiduciary Update. I'm joined here with Alison Bettonville.
Hello.
How's your summer been so far?
So far, so good.
Yeah? Oh, good for you. Well, so on this issue of the Sophisticated Fiduciary, we've got a whole bunch of great things to talk about. There's a lot going on in the summer months, which usually isn't the case, but this summer, for some reason, there is a lot going on. So we're going to go through some quick hits. We're going to look at a survey for the month, and then we're going to take a deep dive on a very hot topic, which is target date funds. The first one's a pretty big one in our industry. The Supreme Court's going to hear this Northwestern case, which I think in a lot of ways could be a watershed event for how fee litigation will proceed going forward.
A couple of important things to note. So when you look at the allegations in this case, they are really similar to the types of allegations that we see in a whole bunch of fiduciary breach cases. The core allegation that the Supreme Court's going to be mostly looking at is around share classes. And the question being asked is it sufficient to allege a fiduciary breach by simply stating in a lawsuit, the plan offered Fund A, and there was a cheaper share class of Fund A available, so therefore the fiduciaries breached their responsibilities. It's a pretty common allegation. What's really less notable is it's not really about that allegation per se. The fundamental question being asked here is that question of what do you have to have from an evidence perspective? What is the sufficient basis to allege a fiduciary breach? In a lot of the litigation, we say the overall philosophy is throw a whole bunch of stuff at the wall. Let's call it mudslinging and see if any of that's going to stick.
Right.
And that's really not a great system in our perspective. It doesn't really take much to file a fiduciary breach case.
Right.
But what evidence do you have to have in order to move forward and actually have that case versus just having it dismissed?
And do we think, that's a great point, because there's so many suits, hundreds, and they're crazy sometimes what the allegations are, and there's no basis. The narratives are poor. The industry really doesn't have a solid foundation of understanding what does record keeping cost and what's involved in servicing a plan, and they throw out these crazy numbers of I should be paying $35 a person instead of $80 a person, with no basis on plan design or complexity or anything of that matter, even size. But interestingly, what do you think will happen in terms of setting some type of standard?
It's really hard to say. On the one hand, the Supreme Court oftentimes doesn't want to get too specific. They want to leave it open. Unfortunately, the courts tend to want to be more favorable towards employees versus employers. But some kind of standard to say, you've got to have some evidence. I think it's important to recognize at the end of the day, fiduciaries are held to their process, not the outcome. And what the courts are supposed to focus on and are supposed to have found time and again is as long as you have a prudent process and based on that process you reach a reasonable conclusion, then we're not going to evaluate the outcome and if it was the best outcome or the cheapest outcome. So hopefully some kind of standard that gets us back to that focus on the process. And makes it, the question again, what do you have to know? What evidence do you need to just bring a claim and getting that to process and not results?
Right. Unfortunately, the process doesn't come up in the claims when you're making the claim. But what we've been talking about here, and you've done a lot of work, and maybe you can comment on it because it's super important for sponsors to understand, is a lot of these suits originate from looking at a 5500.
Right.
Which is publicly available information, so that's usually the first place plaintiff attorneys go. And we have found out in a lot of cases that data could be inaccurate or is reported in a poor manner.
Absolutely.
Maybe comment on that.
Yeah, so I think most fiduciaries aren't really super familiar with exactly what is reported on their 5500 and in their audit report. And that's not to say that they're doing anything wrong per se. There's some definite gray area in, for example, fees. What fees do you have to report on the 5500? How do you report them? And how much transparency is behind that? It's definitely a gray area. And then just to that question of process, companies, you can pull 10 different companies and 10 different 401k plans, 5500s, and audit reports. They're going to look really similar. They're going to use really similar verbiage because that's a standard audit report. That doesn't mean that it's holistic, correct, and it could be not wrong without actually being correct.
Right.
So there's just a lot of opportunity, and we're starting to work with clients to say, hey, just because we don't have to report certain things doesn't mean that we shouldn't consider reporting it and putting out some of those process defenses to get in front of somebody looking at a number, assuming a process and an outcome that is very far off base.
That's a great point. So maybe just let's take it a step further for sponsors who want to communicate more, because there's an argument that says the more I communicate, the more I'm opening myself up.
Sure.
But for sponsors who say, you know what, we're doing the right things here, so we want to be transparent in everything we do, what are the best practices we see emerging from a communication standpoint around plan fees and services?
I think there's a lot of opportunity to be leaders here, and that's what we're starting to think about and talk about, in that ultimately, I don't know that there are many best practices emerging. I'm not sure that this is on a lot of people's radars yet. But the best opportunities we see, and we're starting to look at with our clients, is direct communication to employees. Even if you're not telling them things they don't already know, giving them a little bit more background, looking at how are you putting out information to new hires? Do you have a public-facing and a new hire recruiting website that includes benefit information? Historically, that's only commented on maybe company contributions, but putting some factual information out there about the process the fiduciaries use, that can get some defense out in public. And again, that audit report in 5500, specifically that audit report, you've got some flexibility there to share more information, to be a little bit more transparent. Want to make sure you're never boxing yourself into a corner, being really careful about it. So definitely an area to consider, involving outside counsel, making sure that, somebody is really weighing in and reviewing that. But, what we found is really often, the audit report, the financial statements, they're being generated either by the outside auditor, by people internally, perhaps in finance or audit, that aren't involved in plan oversight. And that's where there could be some disconnects that end up there.
So more to come there, and we'll keep you posted. So let's move on to brokerage window and regulations. Brokerage windows have been around in plans for a long time, and they're coming back up for other reasons now. And maybe we can touch on why they're coming back up and what the best practices are currently and how they might evolve once they're looked at.
Sure. So, overall, brokerage windows definitely more common in larger plans. You'll see upwards of 50-60% of large mega plans, assets over 500 million, a billion with this option. Smaller plans, you're going to see more like 25-30%. Definitely varies by industry as well. White collar industries, higher prevalence of offering versus blue collar industries. Utilization both on the plan level and the participant level has been pretty stable for a number of years, but you're right, Will. They're coming up again for a couple reasons. One, I think with the investment market we saw last year, you had more people, more retail investors who were looking perhaps at their investable assets, including their 401ks, and saying, I'm interested in something a little different, some different types of strategies. They weren't satisfied with their 50-60+% returns in U.S. large cap equity. They wanted the micro cap stocks. They wanted the meme stocks. So that got some attention. Asset classes is definitely coming into play. Socially responsible investments, ESG is a big conversation. Cryptocurrency is another point of conversation we're going to talk about today. But brokerage windows really do provide a potential solution to satisfy participants who are looking for something else, something different, that the fiduciaries aren't sure they want to offer to participants, to all participants, but being able to satisfy that small constituency.
So taking another step into that a little deeper, cryptocurrency, big hot topic. We have a 401k provider that now is offering it.
That is true. So there is a small record keeper called For Us All, primarily services micro plans. They recently announced a partnership with Coinbase. Coinbase is an exchange that supports cryptocurrencies. As part of that program, plans on the For Us All platform can add a brokerage option that is a currency brokerage window. They can transfer up, participants then can transfer up to 5% of their balance into that crypto window and trade cryptocurrency in the 401k plan. So it is something we have had clients that have gotten questions from participants that say, hey, can we get a crypto investment in our 401k plan? Not expecting this to be a widespread strategy at this point. But certainly it's out there, and to the extent that it remains a top headline and popular retail investment, I think we're going to continue to hear about it from participants.
Maybe another potential problem that could be solved by a brokerage window down the road.
Potentially.
All right, let's move on to our industry. It's been another crazy year of M&A activity on both the administration side, investment side, and the RIA side, the consulting side that we do.
Yeah, so I think maybe last month or the month before, we talked about some activity. The pending merger of Aon and Willis Towers Watson had been out there for a while. They had announced that Aon would be divesting its DB administration business in part to satisfy some antitrust concerns. But post that announcement, now just a few weeks later, the deal is off. That wasn't enough to get around antitrust concerns. I'm sure a lot of disappointment there. The deal has been pending for quite some time. A lot of effort went into trying to satisfy antitrust concerns. I would have loved to be a fly in the wall of that conversation where I think the U.S. government said this is just not going to happen, guys. But it's not going to happen.
Yeah, interesting. And I think that story is not over yet. I think that's a ... But let's move to the record-keeping world. Big merger, big acquisition announced just recently.
Prudential has found a buyer for their retirement business. We knew it was on the market, and Empower is the purchaser and going to be continuing to fill up their dance card. As a reminder, they had purchased Mass Mutual's retirement business last year. That integration is underway. Prudential is another pretty sizable piece of business, so really cementing Empower's kind of position as the second largest record keeper in the industry. Looking like that deal will close in calendar Q1, I suppose we should say, pending antitrust concerns. But looking to close in calendar Q1. It's an interesting question. A lot of our clients, especially Empower clients, are asking, current clients saying, okay, how should I think about size in this industry? Is it a good thing? Is it a bad thing? And I think where we come down on it is for record keeping, it's a good thing. I think we can acknowledge it's kind of a commodity business, and there's a lot of parts that scale gets you a lot of value in.
Right, absolutely. And technology is a super large component of it. Having a giant technology budget like both those firms, Fidelity and Empower, do, will just lead to better service for participants.
Technology is huge, and we talk about legal and regulatory change. When you've got a regulatory change that comes down, for better or for worse, I think plan sponsors are looking to their record keeper and saying, we want you to automatically support this new regulatory requirement. And the cost of doing that, whether you're doing it across 10,000 plans, 100,000 plans, not a big difference in cost.
Right, so. Absolutely. You do, however, on the flip side, have to be aware that at some point they get too big and the industry loses innovation and loses the type of work that really generates new ideas and thought leadership.
Yeah, I think innovation is an important thing that we'll want to be sure, and I think there's a great role for fiduciaries, for advisors to continue to push innovation. Another really interesting area will be cost pressures. As industries consolidate, as there's fewer competitors, that's fewer cost pressures, and not to say that downstream cost record keeping fees are going to go up, but
right.
less ability for us to negotiate and find other alternatives. So.
Yeah. And then let's just make a quick point on our industry, the advisory business. There's quite a bit of activity, record number of deals, RIA aggregators. Maybe explain what those are and what's happening in that space and what the impact is on the retirement industry specifically.
Yeah, so, fundamentally, the advisory industry is consolidating as well. It has long been a very fragmented industry with a lot of different types of firms that are offering investment support to retirement plans, whether it's brokers, traditional consulting firms, wealth managers, registered investment advisors like CAP STRAT. And the consolidation has just absolutely started to grow exponentially. Some of that's been driven by the advent of what are being called RIA aggregators, essentially firms that are just looking to buy up a bunch of smaller firms, mash them together into bigger firms, getting scale, turning the advisory business, it looks into more of a commodity type business. So that has definitely been an increasing pressure, and I think the number was 76 deals done just in Q1 alone.
Yeah.
Also being driven by private equity money coming into this space, both supporting some of these aggregators as well as coming into some of the bigger independent firms that remain and looking at them as saying, hey, can we help these firms grow and get more market scale?
Yeah, a lot of interesting elements there we could dig into further, but those types of, when private equity comes in, it's typically transactional. It's not to build value. It's really to just get a multiple and get out. So.
Correct.
Interesting stuff. Let's move on to the survey of the month that we looked at here. And this is Alight, who did a survey on their book of business. And maybe walk us through what we heard, and we can compare and contrast it to the data we have in our database.
Yeah, absolutely. So Alight does a survey actually every quarter. They maintain what they call their 401k index, really tracking investment behavior by participants on their platform and the overall investment results. Important to note in kind of measuring here, first, who Alight's client base is. Alight's client base is really focused on the mega plan market, relatively smaller number of plans versus other large record keepers, but those plans are bigger, so they do represent a pretty sizable number of participants, volume of assets, but really looks more at the mega plan type market. I think one of the really big takeaways here, first, noting that equity holdings and plans hit an all-time high, or a near-term high at least, as of the end of June. Over 70% of current plan assets invested with equity exposure. It's the highest level they've recorded in over 20 years. So we are seeing equity exposure increase. Some of that is trading activity. Unfortunately, we see a lot of participant behavior, we'll call it chasing returns. When markets are going up, people want to get in on the action, but more so, it's participants riding the markets up. We know most participants don't actively manage their portfolios, don't rebalance, so as equities outperform, that exposure is going to grow.
Yeah, I mean, the markets show you basically what has been happening, and
Right.
Trading is low, appreciation super high. There's really not a lot of opportunity in fixed income, and most money is going into target date funds.
Correct.
So that does drive these allocations, and we'll talk about the increase in equity to target date funds in the future. But these figures line up with our data in particular, almost across the board, except in the target date funds. Our target date fund data is much more heavily used than their data.
Yeah, like reporting 30% of assets in their platform invested through target date funds. Our stat, I believe, is right at about 50% of assets in our plans are invested in target date funds. And we can certainly, point to individual plans where that number is 80, 90+%. There's a couple of important factors to consider in what drives that number, whether it's on the plan level or looking at any population of plans. Certainly history is important. How you got to the plan you have today, how long the plan has been around, what's the turnover of the workforce. We know, overwhelmingly 75-80% of plans are using target date funds, and they're using it as a default investment. So new hires are going in there. Alight does support a lot of very large blue chip type companies that have been around for a lot longer in the 401k space. We also sometimes see that those companies are a little bit less progressive. Perhaps they haven't gone back and done a re-enrollment type exercise where they've prompted folks to revisit their asset allocations, and maybe only have new hires going into target date funds as an example. So that's some of the big reasons we see driving some of those differences across individual plans and across populations of plans.
Yeah. So on its face, interesting survey, but as you dig deeper, there's nothing surprising in here that really says, wow. I think it scares people to see 70% of the assets in equity. That seems like a lot, but given the market environment, what the Fed's doing, where else can you go right now, right? And we're going to dig deeper into this target date fund survey, but that being the predominant way people are now saving is probably going to continue this trend as markets continue forward.
Yeah, it's a really interesting and maybe fundamental question for fiduciaries is, do I care about equity exposure? When should I care? And even for an individual investor, is the level of equity exposure a problem? I think I would argue the answer to that question is always no. It only becomes a problem if you react to the market.
Right.
The concern is, are these participants who have 60, 70, 80% of their portfolios in stocks, if we have a March of 2020, are they going to stay the course?
Right. Yeah, and I think that's the fear. The other fear maybe related to that is, if I'm defaulting them into this target date fund and it has all this equity, even though I have protections, am I really protected? Am I doing something that is not in their best interest? So I think that's part, maybe we'll transition to the next topic, which is the deep dive on target date funds, and sort of where this is even coming from is probably from some of these statistics.
Absolutely. So as we dive into target date funds, I think target date funds are in the news a lot, and I'd say the headlines on target date funds are more negative than we would certainly expect. I think more negative than candidly we think is fair to target date funds based on the outcomes they have delivered and driven. Perhaps the first question is why? Why is there so much negativity around target date funds? I think you hit the nail on the head. There is some concern. Have these things really been tested in the last decade plus here of primarily positive equity market returns? I think another interesting question is kind of who's driving the negativity.
Yes. Good point.
It's hard to say from our perspective. It's not plan sponsors. It's not really record keepers. I gotta believe it's probably asset managers. There are $3 trillion invested in target date funds. That is a huge amount of money.
Yeah.
It is also a very concentrated industry. The top 4 target date fund providers are controlling something like 80% of those assets. So arguably, that's a lot of power put in the hands of a few companies who we could name. And there's a lot of other people that would love to have some of that pie and manage some of that money.
They sure would, yeah. So let's just jump into this. So, a lot of this, I think, we're going to talk about the details, but a lot of it comes down to just understanding what a target date fund is. And you look at the performance and the drawdowns, and people get upset over drawdowns, but these are not risk-free assets. So understanding what is being sold to the participant and having them understand it versus what it really is can create a lot of confusion. So,
yeah, I think, as we think about what the issues are here, there's perception and then there's reality, as with all things. And there certainly seems to be a perception that people don't understand what they have. They don't understand that there is risk. They perceive it to be guaranteed. There's the reality that is not the case. That's never been the case. But, from thinking about truly when the rubber meets the road, what is being raised here? There's definitely concerns on the investment strategy side. And do these things have too much risk? As, generally defining risk here to be, in the event of a market drawdown, how much money is somebody potentially going to lose? There's certainly some concerns about, again, the power of the target date fund manager. As we think about the underlying investments in target date funds, among all of the largest target date fund providers, they are large asset managers and they're investing primarily, if not exclusively, in their own in-house investments. There is, some allegations, concern that is leading to a lower quality outcome, although I guess we have to say relative to what, but and then of course everyone's favorite expense ratios. How do we make sure expenses are reasonable? How do you evaluate expenses? Especially because, depending on how you look at it, you've got a wide range of expenses here across strategies.
Yeah, it's definitely not easy. It's not obvious to people. Even we have committee members who it's really not, they struggle to understand the complexities of these things. So let's talk about benchmarking first.
Yes. So that's another issue that's being raised. And I'll say, that's something Congress has asked the Government Accountability Office to look at. There's some legislative proposals to potentially look at shifting here. The question is, how do fiduciaries evaluate the performance of their target date funds? and how should they evaluate that performance? And as our clients know, we have created and maintain a series of proprietary benchmarks. There really aren't great industry standard benchmarks here, in our opinion. They involve a fair amount of subjectivity with respect to risk profile, asset allocation. And as with any benchmark, we go back to the fundamentals. We want a benchmark that can help us assess the investment decisions that the manager is making. And unlike a single asset class strategy where that's basically security selection, it's a lot bigger here. It's first asset allocation, how much stocks versus how much bonds. It's asset class selection, within your stock portfolio, within your bond portfolio, what are the different types of exposures? And then what managers are you picking to populate those asset classes, let alone the security selection decisions made by those managers. So this is a version of an illustration that we look at with our clients quite a bit, and looking at first the universe of target date funds. So the shaded area here shows full range of target date fund universe. And to really hone in on what that means, if we look at the far left-hand side, age 21, for an employee, current 2065 fund. What this is telling us is we can buy a target date fund with his equity exposure as low as 75% of the portfolio and as high as 99%. That's a pretty big range of equity exposure.
Sure is.
And that's the narrowest range in the whole career path out there in the marketplace. So when you think about benchmarking, what we're showing on this chart is, a series of different benchmarks. Industry standard benchmarks from S&P and Morningstar, our series of benchmarks, they kind of have their own positions. Mm-hmm. And so depending on that level of equity exposure, that's going to have a huge downstream impact into how a fiduciary perceives, what conclusion they draw when they compare performance versus a benchmark.
And the unfortunate thing is a lot of people just look at returns. Mm-hmm. And if you look just at this 2020 series here, for someone who is age 66 currently, the range of equity from almost 54% down to 30%, that's going to generate much different returns.
Sure.
But from a risk profile standpoint, you have to choose what's right for you. Mm-hmm. And the plan sponsor is subjected to making sure that that choice is right for them, that they've gone through a process to evaluate what sort of glide path they want to achieve here.
Yeah, absolutely.
So as sponsors look at this information, what are they supposed to consider in making this decision?
Well, as you said, looking at the trade-off of investment performance and risk profile, I think that's really hard for target date funds. In a lot of other asset classes, it's fairly straightforward if we say, look, we want a manager with competitive returns relative to the benchmark and peer group. Consistently performing near the benchmark in the short term typically is going to generate strong long-term results. In target date funds, it's a little bit of apples and oranges. We've got some target date fund managers with more moderate strategies and some that have 20% more equity. Mm-hmm. And those funds with higher equity exposure, if you believe that stocks outperform bonds over the long term, they're going to have a higher return. Mm-hmm. But it's going to be perhaps a little bit more uncomfortable along the way to get there. And, perhaps the dirty secret of target date funds is, if you've got managers truly building their strategies based on their capital markets assumptions, based on their research, but also their salespeople that are saying we need better returns, and everyone knows how you get better returns, right. More equity exposure, and lo and behold, we're seeing equity exposure increase. Yep. But the other side of the coin too is retirement outcomes. And it is possible, if not probable, that every target date fund out there in the marketplace, regardless of whether they're performing in the first percentile versus peers or the 100th percentile versus peers, it is possible that every single one of those series is generating a sufficient return to generate a retirement outcome.
Absolutely.
But unfortunately, from a fiduciary perspective, we got to make sure it's prudent, and we're typically doing that by saying, well, how does this compare to other funds? How does this compare to a benchmark?
Yeah, I think that's a great point you make. And you're just looking at the 2020 fund again, you're looking at anywhere from 20 to 30 to maybe 40 more years of your life, depending mm-hmm. on the slope of the glide path. So that can mean very different things to people.
Yeah. I think the other thing we want to talk about target date funds is how to think about fees, right? And so it's interesting, some people start from the perspective of, I want the lowest fee possible. Target date funds, it's not one size fits all. It's not one size fits all. It's not all else equal, there's some really big levers here with respect to investment strategy differences can have absolutely massive impacts on outcomes. And so what we put together here, these are 7 of the top performing target date fund series, including the 4 largest target date fund providers. Obviously, they're on a blind basis.
In no particular order.
In no particular order. Yep, none whatsoever. And wanted to just illustrate some of those trade-offs. If you just looked at expense ratios on the right-hand side, you would say, I want the top series or I want the bottom series. Those are some of the cheapest series. If you just looked at the column of returns in that middle column there, you would say, I want series 3. I have the absolute best returns. But if you looked at, what is the worst one-year performance, you would say, oh, there's a fair amount of downside here. So how do you think about balancing those factors, near term and longer term? All of these returns are net of fees. Series 3 has one of the highest expense ratios on the board here. Not the highest, but it's higher.
Right.
And, some people say, can you be confident you're going to get more here? It's where understanding the investment strategy is really important. We mentioned one of the things that...
In this case, historically, you have gotten that, right? Because that's a net of fee return of 12.4%. As a fiduciary, though, what do I think about? Well, will I get that going forward? Can I take that risk going forward? How do you balance that with, well, I'll pick the 6 basis point one and I'll be fine?
Yeah, it's a good point. And that's where understanding the investment strategy, understanding, what returns do your participants need and what risks do different segments of your population face? It's a fair trade-off to say, okay, there's some people who need more return. There's some people who we really need to protect on the downside for them. They're saving well. They just don't need that extra return. And so how big are those populations? And how do we weigh those trade-offs?
Yeah, absolutely. It's not a straightforward exercise in any way, shape, or form. So, any final thoughts on target date funding?
One other area I'll mention that I think is misguided, I'll say, is that concept of underlying funds. When you look at those expense ratios, again, as we noted, most, if not all of the largest target date fund managers are using their own in-house strategies. And there's some that are alleging, through research saying, look, this is not an optimal outcome. And at the end of the day, we've seen fee litigation that, for example, has said, T. Rowe Price's fee is imprudent because they use the T. Rowe Price S&P 500 index, and there was a cheaper Vanguard S&P 500 index that they could have used. And it seems to me it's just not fair to look at target date funds as a buffet. If you're buying a prepackaged target date fund series, you are ordering off the menu, saying this is your option and this is what it costs, and you can't. Right. Go into the underlying components and say, well, the answer is don't buy the fund.
Right.
So we're big believers when we're looking at prepackaged target date funds of saying, okay, it's take it or leave it. And at the end of the day, there's actually not that many options out there. And if their perfect mix of characteristics just might not be available. Yeah. And that's where custom target date funds can start to become a compelling option for plan sponsors of saying, I have preferences I want to express. I can't buy that in the prepackaged universe. I want the buffet. I don't want to order off the menu. And, that can be a delicious meal. Yeah,
very reasonable. Well, thanks for the update for the month. And thanks for joining us. We'll look forward to talking with you next month and enjoy the rest of your summer.
Have a great summer.